Welcome to the daily update, where I'll go over the action in the market for Tuesday, July 30th, and then we'll see how things look for Wednesday, July 31st. Had more of a negative day. We're still negative in the short term, but we're becoming a little bit more oversold or extreme negative. We closed right at the 50 period moving average. So the market is kind of on a tipping point on the edge of a knife to see, are we going to be able to break higher or lower? But when we look at the charts intermediate term, we're looking more negative. We're looking better based on price. We're still showing a negative divergence based on volume. In the long term, we're still looking quite positive. In fact, a little extreme positive when we look at our longer term moving averages. Before I get into this, I do have a thing called the SPX Investing Program. I'm going to be locking that down in August. So feel free to check that out. You just have a day or so left before it will require you to log in order to access the information. I also plan on releasing a lot of additional information that I don't have on there now. If you want to go to the website, there's a link. There's also a link to some videos that you can watch, and here's an email address if you want to contact me. The daily video that you're watching right now is really the foundation of the analysis that I do. I post a number of different videos throughout the week. Those are meant to augment the daily video update. So if you want more as it's developing, and if you have the time to be able to watch those videos, they would really be to your benefit, no matter if you're a short, intermediate, or even long-term investor. So let's go back and talk about what happened. We had a higher open. We saw that the last couple of sessions. The futures looked pretty good. It looked like, okay, maybe we're going to get some upside potential here. But we hit that same resistance area that goes back to last Thursday. And I'll show you that when we go to the intraday chart, which happened to be at about the R1 level at 54.86. Then we declined below the unchanged level and the daily pivot at 54.65. Then we declined down below S1 at 54.53. So we were really starting to break below the 50-day moving average. We got down to S2 at 54.22, but we ended up finding support at a round number right at about 5,400. Prices then rebounded back above S2, but they couldn't, they for a while were above R or S1. This should be S1 here, only to close down below S1. We were down 0.5% by the time everything closed, and we were above average with volume. So we did see volume pick up on a down day. We are negative in the short term. We're still negative in the intermediate term, but hanging in there. It depends on what you look at. It's the mega caps and the semiconductors and the growth stocks that are really seeing weakness right now. And that's why we're seeing the S&P 500 going down, where the rest of the market seems to be holding up quite well. Of course, this is the Fed day on Wednesday. They're going to make their announcement. They're probably not going to raise or lower interest rates. They're going to keep them the same, but they'll really be watching for the statement. They'll really be paying attention to Jerome Powell's press conference to see what he says, and the market will certainly be reacting to that. And then all the different geopolitical things that are going on. We've got the whole political situation in the US. There's the Olympics going on in France. Those typically don't have much of an impact on the market, but you never know. Oh, and there's been an escalation over the weekend in Israel. That doesn't have an impact on the market right now, but at some point it could get to the situation developing even to a bigger situation where it could have an impact on the market. Some comments. We're still in wait and see mode as far as the Fed is concerned. That's why we closed right on the 50-day moving average. And then we have the big employment report coming out on Friday. And the S&P 500, it's just a little, it's right at its 50 period moving averages right now. So it's at that tipping point. And it's the mega caps, semiconductors, and growth stocks. These are the things that really led the market higher. They remain under pressure as small caps and the broad market continue to outperform. A little bit longer with our list here, with the Stoke RSI being extreme negative now, as well as the Williams percent R, just the CCI 20, the 14 isn't there yet, and the stochastics. These are our usual charts that anytime we move in one direction or the other, they get it extreme positive or negative rather quickly. In the intermediate term, we're still looking positive with the 10-period moving average of the new highs, new lows for the S&P. This is showing that the rest of the S&P is actually hanging in there for the time being. But on an oversold basis, we have one of our smart money indicators. The Chaikin oscillator is extreme negative. And then long term, we have the 150 and 200 period moving averages. And this also could suggest longer term upward positive momentum. But for right now, we're looking a little bit extreme. And we'll see if the scenario is going to change. As I said before, they're probably not going to, it would really catch the markets off guard if the Fed did something with interest rates like lower them in this meeting. Of course, there's always people that say they need to cut them right now, right away. The Fed's going to do what they're going to do, and the market is pretty much anticipating nothing happening as far as changing interest rates. It's what they're going to say. But now the market is really, really counting on that rate cut coming in September. The dollar was up and interest rates were down. We were at 4.14% with the 10-year yield, where we had been at 4.18%. We're still inverted with those yield curves. We'll see after the employment situation report comes out. If that's starting to show some weakness, that could start to change some of the inverted yield curves that we've been following for over 2 years now. Sentiment is still neutral at 42, where we had been at 46. We are negative with our trend. The ADX is still below its moving average. It's still above 20, so it's a trending environment, but the red line continues to be on top. With the down day, our bias is negative, and then the last number of days, I'm still keeping it mixed for right now. Economic reports. We did get the FHFA Housing Price Index. It was unchanged. Last time it was up 0.3%. The Case-Shiller Home Price Index came in as expected, up 6.8%, down from the 7.3% we saw last time. Consumer confidence a little better than expected at 100.3. They expected 99.8 and up from the 97.8 we saw last time. The job openings were down a little bit, 8.184 million, down from the 8.23 million we saw last time. So here are some charts. Here's the FHFA Housing Price Index, just showing that maybe we're leveling off a little bit, but housing prices, they declined, but have been really going up overall. Then looking at the Case-Shiller Home Price Index, where it is continuing to go up. And then this is on a year-over-year basis, where it's actually showing it declining. Consumer confidence. There are 3 parts to this chart. The blue line is the reading that we just saw. And then looking at the purple line, that's how people are feeling right now. And there's a lot of crazy stuff going on these days. And people are not feeling an awful lot of confidence. They're a little bit concerned about maybe the employment situation report getting weaker. They don't know what the Fed's going to do. They don't know what's happening with all of the events going on politically. But when they look out into the future, they're actually seeing a little bit more optimism. All right. And then the job openings, down from the really high readings that we had been seeing before, dropping off a little bit, but still a respectable number. Looking at some Isabel Net blog charts, we are really coming down with the overall technical score. When we get up into this red area, especially above 80, that's when we're looking extreme. Now we're coming down as the S&P has been under pressure lately. And then equity positioning, it dipped sharply lower this week, but is not necessarily low. We had come almost up to this 1 standard deviation here before falling back, but it's still showing a pretty healthy reading. And the highest alpha for beats since the fourth quarter of 2018. This is when a company comes out with their earnings and they beat both with the earnings per share and their sales surprise, and maybe their forward guidance looks good. The stock is generally rewarded with an upward move when that happens. When they miss on both, it's actually holding up a little bit better, where they were getting hit. Now they go down, but they're not really just getting decimated at this point. And looking at the earnings reporting by week, where we're in the big week right now, 7/29 through the 2nd of August, this is the major part of earnings season. And then mega cap growth and tech positioning. got above this purple line. We're getting a little bit extreme, even though it could go higher than that. It is coming down as we're seeing this shift from the mega cap, tech, semiconductors, growth stocks, still going over into the small caps and the mid caps and across the broader market. And that's why the S&P 500 is holding up better. It's the rest of the stocks in the S&P that are actually holding up, while the big stocks have been seeing a lot of profit taking. Then equity positioning across sectors, even though it's coming down, we still see most of the mega cap growth in tech. That's where we're actually seeing most of the money right now. And then a lot of people are getting into utilities. That would really benefit as well from a lowering of interest rates, staples, the things that you have to have, and financials. Another area that has been doing quite well lately, where we're seeing money going out of all of these other areas. Then the equity flow over the past 3 months has been massive. We're seeing just lots of money coming into the market right now. That's the place where people want to be. And then looking at the cash allocation, folks are taking their money out of money markets, at least according to Bank of America here. And that probably means it's going into the stock market. Now, there's another way to look at money markets where people park their money there because they get a better yield, but it just stays there. That's all. Doesn't want to go anywhere from that point other than if they spend it. Well, there are also money market accounts that people use as a parking place for cash before they do deploy it into the stock market. And we're seeing that coming down when it's measured this way. And looking at the world equity indices right here, or indexes if you're an American, where the S&P is still holding up the best. And then Europe, that's the light blue area here, where it's also been under a decline. Topics, which is more Asia, or I think it's Japan, actually. And then they do the rest of Asia here. Where you look at this all together, they baselined it back at 100, and the U.S. stocks still continue to do the best. And then I've added a new section here since I'm actually subscribing to the service from Edward Yardeni. You can get a 2-month trial for $2.90 per month. So I figured, hey, why not? Okay, let's go for it here. And this is just looking back to July 10th. That's really when this whole thing started to shift. I believe it was July 11th when CPI came out, and that's when the market really said, okay, we're going to start to change the scenario from the mega caps over to other stocks, because now we think interest rates are going to start to come down. And since that time, NVIDIA, which has been the darling to the upside, well, it's also been leading things to the downside. We have Tesla, Meta. These are the Magnificent Seven taken together. You've got Google, Alphabet, Microsoft, Amazon, Apple, and then the S&P 500 itself. Just to give you kind of a graphical representation of what's been happening there. And then looking at the momentum ETF, where it's been coming down. That's the blue line. This is what's really been driving the market higher. It's been pulling back as we're seeing the equal weight S&P, which treats all the stocks the same. That has been showing some real improvement. And charts that I show later on in the video are charts that I show every day, and they're kind of showing the same thing here. And then looking at semiconductors, because they're such a huge part of the tech sector, the blue line is the index itself, and then you just have the equipment, and they have been going down lately. And then looking at NVIDIA, which they have a line right here. Is it coming down to a potential area of support that we might get a bounce off of? We'll have to see how that goes. And then I found a couple of charts here on Twitter. We're looking at the delinquency rate of, this is commercial real estate, and this is a bit of a concern. There are two sides to take to this. One is that these tend to be smaller banks that loan the money out, and they're looking at a lot of having to refinance things and readjust rates. And these smaller banks were looking at interest rates being cut, and that to this point hasn't happened yet. And that's really weighing on these small banks and can produce a problem. On the other hand, there's another side to this that says, no, these guys that are the big players in the commercial real estate, it's a good old boys club, and they'll find a way to work themselves through it where they themselves don't get hurt. There's going to be some damage along the way, but it won't be inside the big boys club where this happens. But in the meantime, we are seeing a delinquency in the rates and a lot of vacancies as well. since the COVID lockdowns, a lot of people kind of like the idea of working from home and not necessarily coming to the office at all or very much. Here's our intraday chart. Looked like we were going to have a nice little upward move. We notice how we go back to Thursday. Now we're not right at the exact point here, but there's kind of a range here where we topped out on Thursday. We got back up to about that point on Friday. We got about back up there on Monday and back about up to this on Tuesday. This is significant, at least short-term overhead resistance. The market just can't seem to break above this level. So when it couldn't do that, then we turned and started to go down. We broke below S1, S2. We found support just a little bit above 5,400. That's where we saw some buying coming in. Try to get back above S1, only to see some selling going into the close, and we ended up being right about on the 50-period moving average. And we're up now again with the futures in the initial overnight session that you see in the lower right here. But that's what we've been seeing the last couple of sessions, only to have things switch once the cash market opens. And typically what will happen on Fed days is there'll be the gyration at the open, as usual, although sometimes it can be rather muted. And then things will settle down and just kind of drift until about 2 p.m. Eastern time when the Fed comes out and makes their announcement. Then there'll be the initial gyration, and then there'll be the press conference, and then there'll be another gyration, which may be in the same direction or the opposite direction. And I just tend to step back on these days and just let the market do its thing. There are lots of other days where we can read more into this, where how the market's going to react is pretty much a roll of the dice when on these Fed days. And then we are seeing where value, the red line, is outperforming growth. That's going up while growth has been going down on an intraday basis. Also, the growth to value ratio for the S&P, this has been declining. And it's not that the S&P is falling apart. It's that we're seeing a rotation out of growth and into value. Our end of day charts, growth was down pretty severely where value was up almost 0.5%. It was up, but less for the mid caps and also up less for the small caps. So we're seeing this across the board. Money just not really going into growth. It's really going more into value. Now, that could be a number of different things that we're keeping an eye on. That could mean that we are getting into an environment where interest rates will start to go down. Okay. And then value stocks and small caps and mid caps tend to do better in that kind of an environment. But at the same time, this is what we saw at the end of 2021, where the market was becoming more defensive, getting out of the growth areas, getting into the value areas, seeing value outperforming growth. And then after that was when we went into 2022, which ended up being a down year. We just will watch this as it unfolds day by day. And that's why I feel there's real value in watching the daily videos that I post. See, we're not just seeing anything here. In fact, some weakness when we look at small cap growth to value, mid cap growth to value, and S&P growth to value. They're just not showing any strength right now. And we're looking weaker here. Now this, you could take this a couple different ways. When we look at the growth to value ratio between these ETFs, yeah, it's really coming down, but look at where we're at right now. Now, a week or so ago, I noticed that the home construction to the 3 to 7 year bonds, it came down to its 250-day moving average and then bounced up off of that and has been looking really good ever since. We're getting really close to this 250-day moving average with this ratio here. Are we going to see a similar type of thing? Are we finally going to hit some support and then be able to bounce up out of this when we compare growth to value? If we do, that could end up turning things back more positive for the market. If we don't, we're probably going to drop below the rainbow. And the longer we stay below the rainbow, then these lines will begin to roll over. Not really seeing any strength here when we compare discretionary to staples. And large cap growth still under its 20-day moving average right here. Actually, this is its 50-day moving average, but still above the 100-period moving average. And this support level was broke really quick. From what I can see, the market is focused on the Wilshire 5000, which is a broad market index, and I'll show you that chart in a moment. But they're really focused on the S&P with the 50-day moving averages. And we are seeing a little bit of a tick down again here when we look at large caps versus small caps on a ratio basis. Here is the Wilshire, where we're still just a little bit above the 50-day moving average. So that's looking a little more positive for the broader market. But when we look at our trend, the red line is still on top. The ADX is trying to turn back up, but it's still in a weakening trend since we're below the moving average. If we continue to decline, eventually this may cross above the moving average, showing that now it's a strengthening trend. And if the red line stays on top, that would be a negative trend. This is also what we're seeing here on the short-term chart, and it's a little bit closer to actually crossing over and turning into a stronger trend. We did pick up with volume. We were below average on Monday, but we were well above average on Tuesday. But we typically see a drop off in July and into August, but we're not really seeing that. There's a lot that the market has to deal with right now. So volume has, for the most part, been remaining rather strong. And we typically will see that with the NASDAQ as well. We are still showing a lot of fear when we look at the Ulcer Index. It continues to go up as the VIX has been going up and as the S&P has been under pressure. So we're going back up with the closing basis here with the VIX on the line chart as well as the bar chart, but not back to previous levels at least yet. And when we have the down day, the VIX of the VIX also goes up with the bar chart as well as the line chart. The momentum of the VIX still continues to be up with the MACD measuring the momentum. And this is what we see seasonally is a rise in the VIX. And that's currently what's been happening right now. We ticked up with the equity put call 1-day chart, but we're still going up with the 5-day chart and the 10-day chart. So that tends to be more negative for the market. The volatility risk premium, we're still coming off of these really, really high readings that we were seeing. We're at the lower end of the band right now. And we were pretty much sideways with this fear gauge where we declined a little bit here with this other fear gauge. And we're seeing the risk on, risk off continue to drop off as folks are switching from the growth stocks back over to more of the value stocks. But we're looking good here. But we also see a negative divergence that we've been seeing now for the last few days. We're breaking out based on price with the S&P, and that's when the S&P was down 0.5%. That just shows you the rest of the S&P is hanging in there. But look at the negative divergence when we look at volume. It was pretty much flat to slightly declining. So price is hanging in there, and most of the stocks in the S&P are doing okay, but it's the really big stocks that are under weakness. That's what's driving the indexes down, or at least the S&P, and also affecting the NASDAQ 100. This is also kind of encouraging. Look at this massive breakout in new highs, even though the S&P was down. And we're kind of going sideways right now with our 5-period, but we're still declining with the 10-period moving average. We're looking good here. When we look at the advanced decline ratio, both with the 19 and the 39-day, they are positive. And we're negative here, though, with the accumulation distribution. We're still below the red line, which is the moving average, and that's declining. We're no longer extreme. It did decline a little bit more with the down day. This is one of our smart money indicators that is negative. Another smart money indicator that's negative is the chicken money flow. We still see weakness here with the red line, which is the moving average going down. We're negative here too with the chicken oscillator, but we're also extreme negative. Now, I put this purple line on here, so there's nothing necessarily magical about that. I use it as a guide just to go back and say, okay, these are other times when we started to get rather extreme. But when you look at the cumulative advanced decline line on the NYSE, look at we're going up there. And we're seeing a bit of an improvement here with the regular NYSE advanced decline line. Also an improvement here with our other NYSE advanced decline line. It's when we compare it with volume. That's when we're getting a little bit concerned. When we look at the NYSE common stock based on price, we're going up here, but we haven't surpassed this previous high yet. But we're really lagging behind when we look at this measure based on volume. We're seeing that in the S&P too. The cumulative S&P advanced decline line based on price, breaking out to new highs, really lagging behind based on volume. This is also hanging in there, showing the red line is actually outperforming the S&P 500. And when we look at our advanced decline line, we were actually up with the NYSE, we were up with the S&P, mid caps, and small caps, when the S&P itself was down 0.5%. See how the shift is continuing to take place here. Here's our short-term chart where we actually broke below the 50-day moving average. And I was making posts on the website, and I do that. Some days I'll make a whole lot of posts if it's more of an exciting day and I think, this might be interesting to let you know about. And that's what you have access to by being a part of the SPX Investing Program. Other days when it's pretty boring, it's like, okay, I might do a pre-market open video and then you don't hear from me until the next day. It just kind of depends on what's actually happening here. But we were able to get back up to the 50-day moving average, and we did go above the moving average down below with volume. And with the Stochc RSI, we are back to being extreme negative. Actually, we've been that way for a few days. The Williams percent R worked off some of that extreme negative reading, and now it's back down below this line here. We're not extreme with the CCI 14, but we are going back to being extreme again with the CCI 20. And looking at the condition of the 20-period moving average with the double and triple exponential moving averages, the lines are going down, and now we're seeing the green line dropping further below the blue line. The green line goes faster on this. It should be the blue line here because that's the triple. Maybe I have the colors wrong here. And we were flat with the 20 period, 50 period, and 200 period, even though the S&P itself was down 0.5%. The force index is still negative, but actually it ticked down just a little bit from Monday. In our stochastics, we are extreme negative in the short term, coming off of an extreme reading in the intermediate short term, and still negative in the long short term. Here is the 20-period moving average. We're still well below that. And this is the exponential moving average, which moves faster. That's the blue line. And price is still well below that. And we're right on the border between the -1 and -2 channel with our standard deviations chart. Balance of power continues to be negative. The go, no-go has now flashed a no-go signal. That's negative. And we're hitting the lowest low value, which is the red line here, and we're below the midpoint. The TTM squeeze continues to show a decline. And here's the condition of the 50-period moving average study here, where the red line is starting to cross below the blue line since it does go faster. And here's our 50-period moving averages. Do you think the market's paying attention to this? Yeah, we've just been camped along this 50-day moving average for quite a while now. And as I pointed out yesterday, is this setting a base for us to launch up out of? Or is this just a plateau before we get ready to fall off a cliff? And in the meantime, we're just going to kind of go sideways. Then we want to keep an eye on the 100-period moving averages in case we do see more weakness to see if that provides support. We are negative with the ease of movement. We're negative with the Erin indicator. We're still positive here and going up with the S&P McClellan oscillator, even on a down day. This is where we're seeing a real negative divergence. We're going up based on price with the summation index. We continue to decline rather aggressively when we look at the summation index based on volume. And I like to point out that the top part of this chart and the bottom part of this chart are two completely different indicators that I've merged into this one chart. And I think it's rather helpful, but they're not necessarily mirror images of each other in how they're calculated. And we're also going back up, and we're above zero with the NYSE McClellan oscillator. So the summation index based on price and volume, they are going up. Now the top part and the bottom part of this chart, they are calculated more in the same manner, where the previous chart are two completely different indicators. These are more of the same types of indicators. And here we're seeing a negative divergence here. We're going up with the Swenlin trading oscillator based on price and above zero. That's positive. We did go up based on volume, but we're still below zero. That's negative. Our momentum, though, is negative with the PMO going down, but we're still positive based on price. We're negative based on volume. So pretty much a flat reading here with the PMOs that are rising, pretty much flat with the buy signals going up just slightly with the PMOs above zero. We continue to be neutral with the Elder's Impulse system for the S&P. We're negative with the parabolic SAR. We're dropping with the slope oscillator and getting down to this red line where we could get into an extreme negative reading. Now we can go below this red line. This is just the area where we want to start to take notice of this. The MACD is coming down and actually getting close to the point where it might drop below the 0 point and turn even more negative. So when we look at all of these together, and you could make a case for some negative divergences as the S&P was going up, we're seeing lower highs with the slope. We did see a higher high with the TSI, but now it's negative and in danger of dropping below the midpoint. We did see a nice little move up here with the MACD, the PMO, and the PPO. These are intermediate term, but right now they're negative. And we're also looking more negative with our longer term oscillators as well. So all the momentum currently is negative. And we're camped out right at the 50-period moving averages. But the bullish percent index actually ticked up a little bit here and has been hanging in there. So the big mega caps may be seeing some pressure, but the rest of the S&P is holding up for right now. This is what's really interesting is the NYSE bullish percent index is actually going up, and we're getting quite high readings here. Saw a bit of a tick up here with the NASDAQ 100 bullish percent index, but we're still negative since we're below 50. The money flow has now dropped below 50. So that had been positive but declining. Now it's actually turned to negative and is still declining. We're bouncing up with the ultimate oscillator, but we're still negative since we're below 50. The red line is on top for the vortex. That's negative. We're below 50 with the RSI 14 as well as the 9. That's also negative. And we're slowing down a little bit as we've been chopping sideways the last few sessions. The standard deviation, which measures the speed over the last 10 sessions, it's coming down slightly now. And we declined here with on-balance volume since the S&P had a down day. All of the volume based on this indicator is counted as negative. And we declined a little bit, but we're still positive overall with those stocks in the S&P above their 20-period moving averages. And not really seeing much of a change here in our study. We actually advanced a little bit with those stocks above their 50-period moving averages, up with the 100-period, and we were up with the 200-period moving averages. The copy curve continues to be negative, another momentum oscillator. The Pring bottom fisher still tried to generate a buy signal, but now it looks like it's starting to go away. We are still neutral with the Sean trend meter as we've been going sideways. This is also a little bit more negative when we look at the itchy and scratchy cloud here, where the blue line has now crossed below the red line, but we're still above the green cloud itself. So I'm following this mainly because of the lines that we see here, not because we're using the cloud as support. We're still looking good here with our 5-period moving average of the highs minus the lows across the broad market. We're well above zero, even though we're off of the highs. And looking here, we are a little bit below this R2 level. This is a weekly chart of the S&P. We were above this, looking really good there for a while. After Friday, we closed right on the line. Now we're just a little bit below the line. And you could pretty much line up this R2 level with the 50-day moving average on the daily charts. And that's why I really like technical analysis, because these things all come together with each other. There's some randomness that goes on in the market, but there's also a lot of convergences of different calculations that all seem to come together as well. And just keeping an eye on our fib retracements, in case we really start to see some more weakness here. We're below this little mini rainbow now and just going sideways. And we're still above the 38.2% fib extension here for the S&P. We haven't quite dropped below that, at least yet, nor have we broken above the 50%, at least yet. And we're seeing things a little more negative now with the hike in ASHI. It was looking a little more positive after Monday. It's hard to see, but this was an open candle, and that's positive. Now with the black candle, that is more negative. And we're negative with the Kigi chart, but pointing up. Or the Renko chart is negative, and the 3-line break chart continues to be negative. And here's where we're looking rather extreme. We're getting above this red line with the 150, and we've been above this line now for quite a while, above with the 200 simple moving average. This is the 10-day average of the highs minus the lows for the S&P. Even though we're declining, we're still above this 90 level, showing that the broader part of the S&P is holding up. And we're negative in the short term with the S&P and the NASDAQ 100. All the other indexes are still positive. So we're negative in the short term with stocks. We're negative in the short and intermediate term with commodities. The dollar was up. So the short-term trend has switched back to positive, where the intermediate-term trend continues to be negative. And no changes here with the decision point scorecard, even though there should have been one. There should be a red down arrow for the PMO. And we saw some positive things right off the bat. Notice how real estate's doing better now because the market's anticipating a lowering of interest rates. Well, then after we hit that upper resistance, then we saw lots of red coming in after that, with tech actually crossing below 50 and turning more negative. And We did see tech down the most. Staples were down and discretionary was down, but energy ended up having a good day, followed by the financials as well. And we're looking good here with our 1 day score of the new highs minus the new lows on the NYSE. We're still well above zero. And the equal weight is outperforming the S&P weighted index. That's why we're seeing this ratio continuing to decline as the rest of the S&P has been holding up better. The Dow was up 0.5%, but it's really not breaking out yet, but it's still looking positive. And we're still positive with the Elder's Impulse system for the diamonds. We're still below the 50-day moving average with the NASDAQ. It was down 1.28%. And the NASDAQ 100 came down a little bit below this pivot point, still below its 50-day moving average, still in a longer-term uptrend, but we're just not seeing an awful lot of strength in the NASDAQ 100 right now. And the Qs are now negative after being neutral over the last couple of sessions with the Elder's Impulse system. The momentum for the NASDAQ 100 continues to be negative, and we're still below this 23.6% fib extension level here and showing more weakness recently. The Qs are below their 20, below their 50, and have pretty much blown that off for right now. It's the 50-period moving average in the S&P that we're really following. Small caps were up, but still have not really broken out above this previous high. And we continue to be neutral with the Elder's Impulse system for the small caps. When we look at the Russell 2000 small caps, still looking good with the RSI. We're above 50, even though it was sideways. Not really breaking out based on price. The momentum is rolling over, but still is positive. And the ratio between small caps and the S&P, yeah, they're improving. And they did improve on Tuesday, but we need to see a lot more follow through here to change this ratio back to positive. The mid caps were up 0.33% and still above this pivot point right now. So they're hanging in there better. And they continue to be positive with the Elder's Impulse system. And we're still battling the 50-day moving average here with the total US stock ETF. Apple was up 0.25%, still looking solid. Tesla was down over 4%, but now we're just working off of a golden cross here as it's switching to an uptrend. Nvidia was down over 7% and well below its 50-day moving average. Microsoft was down 0.89%, and they reported after the close, and last I looked, they were under some pressure there. Meta was down a little over 0.5%, or right in between both of the moving averages. Amazon was down also, and this is what's sucking the S&P 500 lower. And Google was up less than 0.5% and still below its moving average, between both of the moving averages. Netflix was down 0.7%, below its 50-day moving average. The FANG index, also below its 50-day moving average, it was down 1.78%. And we're seeing this continue to go up, the staples to tech ratio. When this is going down, that means tech is outperforming. When this is going up, that means staples are outperforming. And that's a more defensive situation. The fact that we hit this moving average before and turned is a little bit concerning now, because now we're breaking through this 200-day moving average with the ratio. And this is one of the newer charts that I've been showing. It's the ratio between small caps and the tech sector. This continues to go up. It still has a lot of work to do to cross over to a positive trend. The dollar ended up being up and is still in an uptrend on the daily chart. And we're seeing the correlation between US stocks and world stocks still pretty strong on a short-term basis, more weak when we look at the longer-term correlation. We were down with the 10-year yield. We were up with the 10-year based on price. And this is still really encouraging. Home construction to 3 to 7-year bonds breaking out here. This part of the market is completely counting on a rate cut in September. And if it doesn't happen, oh boy. And you notice how we came down to the 250 period and then bounced up off of that in late 2023. And then just a few weeks ago, we came down to this 250-day moving average and bounced up off of that. That's what we're seeing with that growth to value ETF ratio right now. Are we going to see some support like this, or are we going to end up breaking down below it? And then growth to value just not doing good right now with Qs to the S&P. A little bit of an improvement here with discretionary to the S&P, but large cap growth is underperforming large cap value. So the large caps, mid caps, small caps when you look at the growth to value ratios, are just not doing very well. Looking pretty good here with the advanced decline ratio based on price and volume, both are positive. And the S&P to utilities ratio continues to decline, which is putting pressure on the S&P. And we continue to go up overall. It ticked down just a little bit here with staples to S&P, but this going up is a concern. We want this ratio to go down if we're more positive on the S&P. We still don't have a confirmation signal, and we have until this Friday, which actually means next Monday because there's a one-day lag with these charts, to see if we're going to get another spike reading here. If we don't get that, then this will be a false signal for the S&P. If we do, then it's a confirmed signal. And we had all kinds of confirmed signals here with the NASDAQ, and we had another signal lately that has yet to be confirmed here. So what's our outlook for Wednesday? Throughout this whole week, about 35% of the companies are reporting earnings. Now, last week, as of the end of last week, about half the companies have reported, and then the other 35% are still reporting, and then there'll be some others after that. And so, as I said earlier, Microsoft reported after the close on Tuesday. We're going to get Meta or Facebook on Wednesday, and we're going to get Apple and Amazon after Thursday. Then we're going to get that employment report on Friday. So there's some heavy-duty stuff hitting the markets right now. We are still negative when you take the whole picture together, but we're right at the 50-period moving averages for the S&P. We'll get the MBNA Mortgage Applications Index. We see that every week. The ADP Employment Change, Employment Cost Index, and then pending home sales. And then the big announcement's going to be at 2 p.m. Eastern Time. And if you have a chance, if you're interested in it, you can watch it on TV, bring it up live on YouTube. It's going to be where it's at least in Wednesday's session. And then all the different geopolitical things going on. And then on Thursday, we're going to get the ISM manufacturing. On Friday, the employment situation report. And let's see. Yeah. I don't have the Chicago PMI on my count, and I'm not sure why. It usually includes that there. Seasonality, we are negative with the Dow and negative with the NASDAQ, where we're neutral to negative with the S&P. This is the last day of the month for July. And that tends to have some negative seasonality here, even though during an election year, we see a little bit of positive seasonality. But here on this chart, we see some negative seasonality. Oh, isn't that great? And then we're still kind of far away from, when you take all the election years together, we've got quite far away from that. So we could be reverting back to the mean, so to speak, here. Wednesday is the most negative day of the week based on what happened in 2023. And I might just stop showing these charts because we've kind of got a lame duck president now, it looks like, because the current president's not running for re-election and he's no longer a new president, but yet he still is at the same time. And so I'm not quite sure what to make of this. And same thing here with this seasonal chart. And where are we at with this other seasonal chart as well? And we're coming up to the end of July, which has certainly lived up to what seasonally has happened. We saw a really solid first part of July and not as much. We might even be seeing some negative readings for the second half of July. And here's another one, just kind of show you looking out into August. And I've not received the daily chart from Stock Traders Almanac yet, so that might be a couple of days late here. But we do see some positive returns in August. And then looking at our warning signs, we're still keeping an eye on these defensive sectors. And we keep asking the question every day, is this because the economy is shifting to a lower interest rate environment, or is this the market becoming more defensive before it gets ready to go lower? And growth to value, discretionary to staples, they're just not doing well. Our equity put call ratios, the 5 and 10 days, they're going up. That's negative. And then we have our 3 smart money indicators, which are all negative right now, with the Chaikin oscillator being extreme negative. The parabolic SAR, ease of movement, the money flow, which is now a new addition here. The vortex, our oscillators, the ultimate oscillator, the Copic curve, and the momentum for the NASDAQ 100, as well as the bullish percent index. On the positive side, this is looking quite good, the bullish percent index for the S&P. And our advanced decline lines are hanging in there pretty well. This is where we're seeing some negative divergences, especially within the S&P. We have price going up and volume going down with the summation indexes, but the McClellan oscillators and summation indexes for the NYSE, they're looking really pretty solid right now. And we're seeing a mixed picture with the Swenlin trading oscillator. Positive based on price, negative based on volume. The bullish percent index for the NYSE is looking pretty good. It's actually breaking out a little bit. The financial sector is doing quite well also. So we're still negative and we're at the 50-period moving averages. In the short term, we're below the 20, so we're negative there. Our list is a little bit longer, so we're becoming a little bit oversold that way. In the intermediate term, what else can you say? We're at the 50-day moving averages. There's some things that are positive. Our charts are looking more negative, but until the market decides what it wants to do, we're kind of held hostage around the 50-day moving average. In the long term, though, we are still positive, but we're looking a little extreme positive or overbought with our 150 and 200 period moving averages. Thank you. I really hope you found this helpful. I hope you have a good day. It should be an entertaining day. And I will talk to you in the next video.